So my name's Julie Criglio. I work at Portage Community Bank. I've been there about 13 years now, and I am one of their lenders. And so today I'm here to talk to you about any first-time homebuyer programs that we offer, or just a homebuyers program in general. So if you have any questions about mortgages or how to attain them or what's the best route or anything like that, I'd be happy to help you with that. So today, the biggest first-time homebuyers program that we work with is through the state of Ohio, and it's referred to as OFA. And with those programs, there's down payment assistance, there's first-time homebuyers programs, there's programs for certain types of occupations. So if you're a teacher, if you're a policeman, if you're a nurse, a doctor, and it also goes down to like STNA, stuff like that. But those are called the Ohio Hero programs. Then we also have VA programs, which work with any type of military service, whether you're currently serving or if you have been honorably discharged. We have programs for that too. So today we'll go over that. We'll go over what you have to do to be eligible. Then we'll have some other questions in there, and then I'll also tell you what you need to have if you were to make an appointment to get pre-approved. No matter what type of mortgage you're looking for, I always recommend that you get pre-approved. That way, when you're walking into a situation, you know that you're going to be comfortable with what you're walking into. So you're not going to be walking into a $300,000 house when you can only afford one that's $150,000. You don't want to put yourself in those situations, and you don't want to get into something that you're not going to be able to get out of later. And these programs are really good at giving you extra information and resources to make sure that doesn't happen. So with OFA, we have the Ohio Housing Financial Agency, and they're the ones that can help. With the OFA programs, they are 30-year fixed rate conventional FHA, VA, or USDA loans. So those are all government backed, and they have certain advantages to each. Conventional ones, they have a minimum down payment of 5%. There are a few programs out there. One's called Home Ready, and it does require 3% down, but there are a few extra hoops that you have to jump through for that one. But the best part of these is that you have the 30-year fixed rate. With the Ohio programs, you do have income eligibility limits. So it's mostly you have to make between this amount and this amount. And if you aren't between those limits, it will tell you what ones you do qualify for. So it goes by county. So depending on which county you are in, the maximum limit might be higher than other counties. Just in Portage County, we have, I think the maximum loan limit you can go up to is $345,000. So we do have to keep that in mind depending on what program you're going to go for. So they have your choice down payment assistance. So this is where you can either choose the help for 2.5% down or 5% down. So that can help you toward.
Is it possible for you, if we left the email, for you to send the PowerPoint to?
Oh yeah. Yeah, if you want to give me your email, just go ahead and give me your email, and I'd be happy to send you the PowerPoint, and I will send you all the websites that are referenced in this PowerPoint.
Thank you.
No problem. So with the Your Choice down payment assistance, the 2.5% down or the 5% down, that can go towards your down payment or cover closing costs. Because even if you have your down payment, you always have to remember there are closing costs associated with all loan products. Assistance can be applied, as it says, down there or to your closing costs. Another nice thing about first-time homebuyer programs, when you are working with your realtor, you need to be upfront with them and let them know that you either have the money to cover everything or you don't. So if you have the money for most of your down payment and a little bit of the closing costs, let them know that, because they can always ask the seller to pay a portion of the closing costs. And that will help you have to bring less money to the table, and it also gives you more money towards your down payment if you need it that way. Let's see. Assistance is forgiven after 7 years. So you do have to stay in the home for 7 years. Otherwise, a portion of this is owed back. The down payment portion of it is a grant, so you do have to stay within the program a certain amount of time for it to be forgiven. And another thing to point out is when I'm saying a first-time homebuyers program, if you've already owned a home in your life, but you haven't been in that home for at least the past 3 years, or you haven't bought another home in the past 3 years, you still can qualify for the first-time homebuyers. But you cannot have 2 FHA loans at the same time. So always keep that in mind. And you can't, I don't believe you can have 2 OFA loans out there at the same time either. Okay, so this part is what it would take to be the first-time homebuyers one, but this pretty much works across the board with all types of loans. So you have to meet the income and purchase price limits. For the most part, if you weren't going for the first-time homebuyers program, there aren't usually limits. There might be in-house limits, or there might be limits with whomever they're trying to sell the loan to. But for the most part, those usually aren't something that you have to worry about. The credit score requirements, though, those are very important. So with FHA loans, if you're just getting a standard FHA loan, they will work with people who have lower credit scores. But you have to find a bank that's willing to underwrite the loan by hand. And there are a few banks out there, but you have to know that if your credit score is below a 630, it is hard for us to get you qualified for a mortgage. So working on that credit score is very important. With conventional loans, in USDA and VA, you're required for a 640 or higher credit score, and for FHA loans, it's 650 or higher. And then for the debt to income ratios, they're different for each type of loans. For the VA USDA loan and conventional loan, there is a debt to income maximum of 45%. So what your debt to income is, it's the amount of debts that show out on your credit bureau, plus your new mortgage payment, taxes, and insurance. So they take all that into consideration, and then they take your monthly gross income. And that's what it takes to figure out your debt to income ratio. And you can't have your debt out there over 45% of what you bring in. So that extra amount that's out there, that's to pay your incidentals. So we don't take into consideration your utilities. That extra amount that's left over the 45%, that 55% is left for what you would be using to pay for everyday things like your gas, your electric, utilities, anything like that. So that's what it is. We want to just make sure that the amount of money that you're paying out each month isn't going to be all the money that you have. And that's mostly what the debt to income ratios tell us when we're going about this. For the FHA loans, from a credit score of 650 to 679, your debt to income ratio can go up to 45%. For anything above 680, the debt to ratio income can go up to 50%. If you're doing a standard FHA loan, the debt to ratio income can go up to 55%. So if you would have your own down payment money and you didn't need any type of assistance, the debt to income ratio is a little higher. But know that when you're pushing to be right at that top of the debt to income limit, it can kick out your loan so it doesn't qualify. So if you could be at least a couple percents below that, it does help. You just don't want to be at that max line. Okay, so with the OFA program, it does require you to take an online course. It tells you what you need for the debt to income ratio. It will go about how you're supposed to pay your bills on time, what it takes to own a home, what you're going to be responsible for. All that is required for us to go ahead and move forward with this program. And then it takes about 25 minutes. There's a couple of tests within it, but they are quick and easy. With the whole website that I'll go ahead and send you guys, there are different things out there that how do I put it? There are different programs out there that you can stack on top of each other. So if we look at this one at the bottom, receive a $25 gift card for participating in a study with the Ohio State University. So if you go ahead and sign up for that one, they'll just ask you a few questions. You have to do a survey, and they use that information in their studies that they're conducting. So you can do stuff like that. There are certain ones where you can stack on top of it to get tax rebates. Those ones are eligible no matter what program you're doing, if it's an FHA program. Okay, so how do you apply? You can go online and you can look at a list of OFA approved lenders, or you can always call the phone number. Most banks work with these programs. Some of the bigger banks have their own programs that you can work with, but if they're a smaller bank like we are, we do work with these programs, and these are the ones we have. And we also have a Home Ready program that goes through the state of Ohio that will help you out too. Okay, that was real short, but I do have a couple other things for you. So if we go back to the whole having a pre-approval thing, when you're getting ready to go in and meet with your lender and get your appointment and decide that you want to look at getting a home and seeing what you qualify for, there are a few things that you need to bring with you. They're going to want to take an application. They're going to need 2 years tax returns with W-2s, 2 current pay stubs. They'll need 30 days worth of checking or savings statements, and that's to verify that you have your down payment in those accounts. You'll also need bankruptcy paperwork if you've been part of a bankruptcy, and or divorce paper or child custody with showing your child support if those also are applicable. And then you'll need a copy of your driver's license. And what else is good to bring in? If you want, it's always good to have your questions written down. Once you get past the pre-approval program, that'll tell you what you are eligible for to purchase. Then you'll want to start working with your realtor. So then you'll want to find a realtor that works with you, that you get along with, because this is going to be the person that you're going to have to deal with a lot. So these realtors out there are the ones who are going to steer you in the right direction. So they're going to be like, okay, I know you like this house, but this is out of the range based on your pre-approval. So I'm going to show you this house, which is similar. And so you're going to want to listen to them because they know their stuff when it comes to what the houses are worth and what you need. So a good realtor that you get along with is always, always important.
So can you go over what you're gonna need again to take to that meeting? I got 2 current pay stubs and then I missed something.
It's okay. So you'll want 2 years tax returns with W-2s.
Okay.
You'll want the 2 current pay stubs, 2 months worth of bank statements, whether it's checking or savings, and that's to show that your down payment is in there. Okay. If you're going to, this is a side note, if you're going to have a family member gift you money, there will be a donation letter that they need to fill out, and there will also be a few things that the mortgage lender would ask from you. They're going to want to ask for a statement showing that they have that money in their account, and then they're going to also ask for a copy of the check that they give you, and then they're going to want to show the deposit going into your checking account. One of the big things that you also need to remember when it comes to going through this loan process is don't have cash. They have to be able to track where your down payment is coming from. So if you would have cash that you're keeping to the side at home,
you're good.
Yes, putting in your mattress, putting in the freezer, you're going to want to move that to a savings account so they can verify that that money is out there. Mm-hmm. They just want to make sure that I didn't give you the money and then I'm saying, okay, you have to pay me back at this rate. And then you're going to have an extra payment on top of what you already have. So they're going to watch for that. And then copies of your driver's license is always helpful. Any type of divorce decree or bankruptcy, they will ask for those. And then if you have any type of child support, they'll need that also.
How about spousal support?
Spousal support also. Yeah. And somehow the underwriters always find those things. So it's better just to have them up front. And then, is there any other questions that you have off the top of your head?
Does this all apply if you want to build your own home too, or is that different?
So building a house is different. There are certain programs that would work with that. I believe USDA has a program for that, and so does a VA program. But to build your own home, you're going to need a minimum of 5% down, and you're going to have to get what is called mortgage insurance. Mortgage insurance, unfortunately, protects the lender, but it doesn't protect you. So it's if something goes wrong with the loan, it does cover with us. And the mortgage insurance companies require 5% down, and that will fall off once you reach 79.5 loan to value on your home. So that mortgage insurance isn't out there always. But for construction loans, there's a couple ways you'll go about that. If you already own the land, that will help you have equity towards your total down payment. If you don't own the land, you can purchase the land and have your plans to build on it all at the same time. It's easier to have a contractor. So if you're looking to build in a development, they'll already have everything set up for you. They'll tell you what you need to go through, everything like that. If you're just purchasing your own property and going out there and getting a contractor and stuff, there are a few other things that you'll need to bring to the bank. You'll need a copy of the specs, you'll need a copy of the cost breakdown, and you'll need to have your contract with the contractor. It's a little different when you do the construction loan, because normally for construction loans, your first year is interest-only payments. That's when your construction period is supposed to be going on. So during that period, you'll be only paying interest only, and that's to help you with any extra incidentals that come up while you're building. Because even though you have that cost breakdown, it doesn't mean that it will always be sticking exactly to that. And then after that, you have your 30-year mortgage. So it's technically a 31-year mortgage, except for that first year is interest only. So there's not as much help out there for that. Do you have any other questions? Because let's see, about construction loans, what else is there out there about that? The MI portion is really good to know.
What about multifamily?
Multifamily homes?
Yeah, but with using an FHA loan, you plan to live in a unit and then.
Okay, so you can do that. So for the first time home buyers program, you can do it with a duplex. So you would live in one half and someone else would live in the other. That does tend to require more money down. So you would still get that first time home buyers rate, but the down payment assistance you can't usually use for that program. And the minimum down payment on duplexes is 10%, but depending, some places will have to have that 20% down. When you do have that duplex, if someone is already renting the other half and you're going to continue to rent that to them, you can count that income. But otherwise, you'd have to be able to qualify just based on your own income. You couldn't count that rental income that you would be getting. But it is out there. There are programs that do allow you to do the duplex. I don't think we can do triplexes, but duplexes for sure, I know there are programs out there for. But that's always a good way to look at it too, because you always have someone paying the other half of your mortgage for you.
The hope.
You hope, yes.
Yeah.
It's a big step. Yes, it's a big step. You're going to go into your first-time home buyers program, and you're going to be a realtor. So that is a big step to walk into. But I have seen it done, and it has been very helpful. Let's see, what else do we have around here that's helpful? So with FHA programs, there is a maximum and minimum amount of land that you can have. So you have to have at least an acre for certain programs if you're with outside city limits. And then there's a maximum of 7 acres if you're outside city limits. If you're within the city limits, normally the standard plot that you're built on is regulation based on the city. So that is something we've run into. If you are buying a house that doesn't have city water or city sewer, you do have to have a well test. They test the well flow capacity, and you have to have a septic test, and those have to pass to be with FHA. When you're also doing FHA homes, they do have to pass a special inspection. So I know, like with FHAs, if the house has a porch but it doesn't have a railing, you would have to ask the seller to put a railing up prior to that house being approved to go that route. Sometimes if the electric's not up to date, it will have to be updated in order for that house to go FHA. Sometimes if you have the down payment money, you can switch to conventional. You don't have to worry about that inspection, but know that those are out there when you're looking for your FHA homes. So if you're looking for a fixer-upper, sometimes the first-time home buyers program is not going to work for that. Let's see. What else is out there that tends to pop up? Know that when you are going through the loan process that your credit is being monitored. So if you go out and open up any other type of credit cards or buy a car or anything like that, that does impact everything. So that could impact your score, that can impact your debt to income ratio, and whomever is underwriting your loan, they're going to ask for a copy of that agreement. So if it's a credit card, they're going to want to see your first statement. If it's a car loan, they're going to want to see your notes stating what the payment's going to be. So we've ran into that before, that people are buying a new home, so you need new furniture. So you go to the furniture place and they offer you financing, and then we have to make sure that we count that payment. So they will ask for stuff for that. With the first-time homebuyers program, though, it really is a good program. It's not super hard to qualify for, and the down payment assistance part is very, very helpful. And like I said, depending on what your occupation is, those programs are out there too. But no matter what, the first-time homebuyers is good. And there's also a program out there called Next Home Buyers. And that's for people that are planning on to sell the one house and move into another. So if you had a first-time home buyers program and you're selling that house and moving into another, there is another program out there. It's similar, but I don't believe you have to take the course over again.
Question for you.
Mm-hmm.
If you're going through a dissolution
Okay.
and the other party is staying in the previous house,
Mm-hmm.
so they're basically buying out your portion, would you, as the person who's moving out of the house, would you qualify for first-time home buyer?
If you haven't been in that house if you've owned that house for more than 3 years, yes. So you would qualify for that. And with the whole dissolution, chances are you would have to have that all complete prior to going into purchasing the home, especially if there was any type of spousal support.
Oh, yeah. That's
Yeah. And then
3 to 6 to 12 months away.
Yes. Well, hey, I
God
get
only
it.
knows.
Yeah. But yeah, that is That's still doable with that program, especially if there's a mortgage already on that house and they're refinancing.
Yeah.
That's even better.
That's what will end up happening.
Yeah. But yeah, for programs like that, yes, there are, you can still use the first-time home buyers. And like I said, if not, there's always the next-time home buyers. The rate might be a little bit higher, but it still has the good perks of using the program with it. Anything else?
Do all banks have some version of that, or?
Pretty much.
Yeah. Okay.
I can't speak for credit unions because they can kind of do their own thing, but most banks do have something. Like I know Huntington has their own program, but I also know that certain Huntingtons do have still work with the first-time home buyers and the community first.
Okay.
I believe Chase does it, and so does Key. And those are the big ones around here.
Yeah.
PNC, I think, does it too. Or if not, they have their own program. But, so yeah, I mean, make sure you get along with your realtor, so that's always helpful. And pre-approvals, that's the way to go. And even if you wanted to get a pre-approval prior to going out and looking, like you're not still planning for a year, you can still do that. It will hit your credit, but it'll at least give you an idea of what you need to do to get ready for that.
Would you still need the down payment amount in your bank statement, like for the appointment, if you're not like?
If you're not doing it right away, no.
Okay.
No. So if you're going to go in and just see how everything's working now and you want to know what you have to do to get to the point where you can buy a home, no. But they will tell you what you'll need, and then you'll have a goal for that too.
Okay.
So that's always helpful.
Do you see a lot of people trying to do rent-to-own homes because of the interest rates right now?
Yes.
Or you're hearing about a lot of it, I should say?
I haven't heard, I've dealt with land contracts a lot. I've seen some rent to buys. I haven't really seen a lot as it spike up lately, just because interest rates went up so fast. It hasn't been this high for that long, but they're good. I just recommend that if you do get in a situation like that, that you document everything and make sure that you have everything in writing. Because when you're doing the rent to own, say you're in there for 2 years and you decide that you want to buy it out, that money that you've paid so far, a portion of that's supposed to go to your equity. So it's supposed to say you've already bought this much of the house, and that will go towards, you'll need less of a down payment that way. You just have to make sure that that's documented really well, so that the numbers that you're saying and that what
Agree with the numbers of the other person?
Yes, so you want to make sure that that is documented. But
Okay.
we have dealt with those. When you're doing the rent to own though, that doesn't always count as a purchase. That's usually considered a refinance because you've lived in the home for X amount of time. So there aren't a lot of down payment assistance programs or anything out there with that, because you already have that equity built in. But yeah, documentation is the best for that one.
Okay.
Anything else? Because I think we're about done. Okay. But
Thank you very much.
No problem.